Are you ready to unlock the strategic power of corporate numbers? Welcome to the Ultimate Online Master of Business Administration lecture series in Management Accounting. This is not about boring, historical bookkeeping. In this course, we bridge raw financial information straight into advanced executive decision models. My colleague will take it over from here on. Thank you.
Welcome to Master of Business Administration, MBA, online program. This is Chapter 1, Introduction to Management Accounting. In this chapter we look at chapter overview and table of contents. Module Architecture 1.1 Foundations of Financial Accounting, FA, Definition and Core Coverage 1.2 Definition of Management Accounting, MA, Frameworks by Global Professional Accounting Bodies 1.3 Scope of Management Accounting, MA, Overlapping Corporate Boundaries 1.4 Core Control Systems and Tools. Operational Management Frameworks 1.5 Comparative Analysis Matrix. Interdisciplinary Boundary Walls. Next slide is Unit Objectives. Bullseye: What students must master. Explain the scope. Understand the exact functional reach of Management Accounting, MA. Distinguish operational boundaries. Clearly differentiate between related business tracks. Management Accounting, MA, versus Financial Accounting, FA. Management Accounting, MA, versus Cost Accounting, CA. Management Accounting, MA, versus Financial Management, FM. Analyze control frameworks. Understand how modern information pipelines drive sustainable corporate advantages. In this slide we will look at foundations of general accounting. Classical building: What is accounting? Core definition: accounting is the systematic process of identifying, measuring, recording, and communicating the economic events of an organization. What it covers: bookkeeping, keeping chronological records of day-to-day business actions. Classification: grouping similar transactions into specified ledger accounts. Summarization: preparing primary financial summaries at regular intervals. Interpretation: analyzing final accounting summaries to evaluate enterprise health. Department store real-world corporate example. Scenario: RIL sells 10 lakh rupees worth of products. Application: the transaction is recorded in the sales journal, posted to the ledger, and reflected in the end-of-year profit statement. Slide 5 teaches the definition of Management Accounting, MA, Clipboard Core Internal Frameworks. Primary concept: Management Accounting, MA, is the provision of precise financial and operational data tailored for internal company leaders to plan, make decisions, and control activities. Core Global Academic Definitions. International Federation of Accountants, IFAC, the systematic process of identification, measurement, accumulation, analysis, preparation, interpretation, and communication of information used by management. Chartered Institute of Management Accountants, CIMA, the provision of information required by management for policy formulation, planning, controlling, and safeguarding assets. American Accounting Association, AAA, the application of appropriate techniques and concepts in processing historical and projected economic data to assist management in establishing reasonable economic plans. In this slide we will learn the core features of Management Accounting, MA, gear operational traits. Internal focus. Reports are customized for managers rather than external stakeholders. Futuristic orientation. Focuses on projecting future performance instead of just analyzing historical transactions. Flexibility of format. Free from rigid statutory accounting rules. Data is presented in tailored, user-friendly layouts. Approximate data speed. Prioritizes rapid reporting speed over 100% mathematical precision. Department store real-world corporate example. Scenario: Tesla designs a forward-looking cost plan for an electric vehicle assembly line. Application: managers use current estimates to project costs rather than waiting for final invoices. So what is the scope of Management Accounting, MA, hammer and wrench interdisciplinary coverage? Financial Accounting, FA, data feed, uses base balance sheet data as raw material for further analysis. Cost Accounting, CA, analytics, uses baseline unit expenses to calculate profit margins. Financial Management, FM, integration, connects day-to-day data with long-term fund planning. Management Information System, MIS, operations. Feeds data pipelines straight into digital corporate dashboards. Slide 9. Operational controls, MIS and MBE warning control systems explained. Management Information System, MIS, establishes automated data sharing networks across all company levels. Transforms raw ledger entries into concise summaries. Management by Exception, MBE, an efficiency-focused control model where errors trigger immediate alerts. Performance variances are reported only when targets miss expectations. Helps executives save time by allowing them to ignore smoothly running departments. Department Store Real-World Corporate Example. Scenario: Honda sets an operational budget where steel expenses are capped at 50,000 rupees per month. Application: if expenses spike to 55,000 rupees, the system triggers an alert. Outcome: the regional manager intervenes immediately to fix the cost deviation. Slide 10. Let's compare operational matrix, FA versus MA. We will break down the precise operational matrix that separates financial accounting from management accounting across 5 key dimensions. Let us break this down step by step to ensure absolute clarity. First, let us examine the legal mandate. Financial accounting is strictly compulsory. Every corporate entity must maintain these records under the statutory regulations of the Indian Companies Act. On the exact opposite side, management accounting is completely optional. There are zero statutory constraints or legal requirements forcing a firm to use it. It is implemented purely at the discretion of the company. Second, consider the target audience. Who actually uses this data? Financial accounting focuses outward. Its primary frameworks are built to serve external parties such as equity investors, commercial lenders, banks, and government tax bodies. Management accounting, however, looks entirely inward. These specific reports are designed exclusively for internal corporate leaders, including managers, department heads, and C-level executives who drive daily operations. Third, let us look at the data scope and depth. Financial accounting operates with a macro focus. It treats the entire corporation as one single, consolidated unit to provide an overall health check. Conversely, management accounting uses a highly detailed micro focus. It breaks the data down into individual segment-level performance, regional metrics, and specific product line costs. Fourth is reporting speed and velocity. Financial accounting reports are backward-looking and compiled slowly because they require precise, audited validation of historical data. Management accounting completely prioritizes decision speed. It delivers rapid, immediate estimates and real-time operational flashes so that leaders can react to market shifts instantly. Finally, let us address report formatting. Financial accounting must rigidly follow standardized, statutory regulatory templates so that external analysts can easily compare different companies. Management accounting throws away rigid templates. Its reports are completely custom-built and tailor-made to match the exact operational requirements of internal management teams. In summary, remember this core rule of thumb. Financial accounting is about external compliance, precision, and historical recording. Management accounting is about internal control, speed, and future strategic planning. Thank you for listening. Let us move forward into our next core module. Slide 11. In this segment, we are continuing our deep dive into accounting frameworks by exploring the clear structural boundaries between operational mechanics and strategy. Specifically, we are going to master the explicit differences between cost accounting and management accounting. Let us break down this matrix across 4 critical evaluation dimensions. First, let us look at the primary target. The fundamental objective of cost accounting is to ascertain, allocate, and track exact product unit expenses. It isolates costs directly at the production level. On the other hand, the primary target of management accounting is strategic. It exists to analyze downstream business impacts and high-level operational choices to guide executive leadership. Second, consider the information scope. Cost accounting has a highly specialized, narrow focus. It relies heavily on manufacturing cost ledger fields, tracking things like raw materials, factory overheads, and direct labor. Management accounting opens up a much broader focus. It synthesizes traditional accounting records with corporate economics, market statistics, and financial modeling to look at the bigger picture. Third is time orientation. Cost accounting is mostly historical in nature. Its primary function is to track and audit past factory expenditures that have already occurred. In stark contrast, management accounting is explicitly futuristic. It is heavily predictive and relies on forward-looking forecasting models to plan for the upcoming business quarters. Finally, let us examine system interdependence. Cost accounting operates as an autonomous baseline. This means a company can install and run a comprehensive factory cost tracking system completely independently, without needing any higher-level management accounting modules. Management accounting, however, features a dependent architecture. It absolutely cannot function without a proper baseline cost database already feeding it raw information. To summarize this contrast simply for your notes, cost accounting is the mechanical engine that isolates and measures product costs on the shop floor. Management accounting is the strategic framework that takes those costs, adds macroeconomic variables, and projects them into the future to make profitable executive decisions. You can proceed to the next module for our review. In slide 12, we are analyzing the clear structural differences between financial management and management accounting. Let us break this down across 4 vital evaluation dimensions to ensure complete clarity. First, let us examine the capital scope. Financial management focuses heavily on external resource management. It is the practice of sourcing, procuring, and raising business capital from the outside world. Management accounting, on the exact opposite side, handles internal resource consumption. Its entire goal is to maximize the operational utilization efficiency of the funds the company already possesses. Second, consider the market interface. Financial management maintains a strong external focus. It handles the continuous liaison with investment bankers, stock markets, commercial lenders, and public shareholders. Management accounting operates with an entirely internal focus. Instead of looking at capital markets, it works with departmental leaders to build internal operating budgets and detailed performance plans. Third is asset security and protection. Financial management provides financial protection for the firm. It continuously monitors corporate credit lines, cash collections, and overall loan exposure to prevent liquidity crises. Management accounting provides operational protection. It safeguards physical and monetary corporate assets from the inside by building internal audits, dual authorization checks, and fraud prevention controls. Finally, let us look at the key metrics used to measure success. Financial management focuses on optimizing the overall capital structure of the firm, managing debt-to-equity ratios, and securing long-term enterprise liquidity. Management accounting evaluates success by tracking performance. It focuses heavily on monitoring internal responsibility chains, analyzing cost variations, and assessing whether managers are meeting their targets. To summarize this comparison cleanly for your notes, financial management is all about bringing money into the firm and managing capital markets. Management accounting is about strategically tracking how that money is spent internally to drive maximum efficiency. This concludes our core comparative modules for this unit. I appreciate your value and time. We now dig into questions and answers. Question 1. Conceptual scenario. ABC Milk is analyzing its dairy division. Team Alpha calculates that the exact cost of electricity and raw milk required to produce a single 200 grams block of paneer is 42 rupees. Team Beta uses this 42 rupees calculation to build a 3-year market forecast to see if dropping the selling price will double their market share. Which team is performing cost accounting, CA, and which team is performing management accounting, MA? A. Team Alpha MA, Team Beta CA. B. Team Alpha CA, Team Beta MA. C. Both teams are performing CA. D. Both teams are performing MA. Question 2. System interdependence, true or false? A company can successfully install and run a cost accounting, CA, system even if it does not have a management accounting, MA, system in place. A. True. B. False. Question 3. Time orientation. While cost accounting, CA, looks predominantly, X, to track and audit expenditures that have already occurred, management accounting, MA, is explicitly why, because it builds predictive models for upcoming corporate quarters. A. X. Futuristic, Y. Historical. B. X. Flexible, Y. Standardized. C. X. Historical, Y. Futuristic. D. X. External, Y. Internal. Question 4. Capital scope. The Chief Financial Officer, CFO, of ABC Motors is meeting with investment bankers to issue a new series of corporate bonds on the stock exchange to raise 500 crore rupees for a new factory. At the same time, an internal factory manager is reviewing monthly departmental spreadsheets to ensure the assembly line workers are not wasting raw steel. The CFO's action falls under X, while the factory manager's review falls under Y. A. X. Management accounting, Y. Financial management. B. X. Financial management, Y. Cost accounting. C. X. Financial management, Y. Management accounting. D. X. Cost accounting, Y. Financial accounting. Question 5. Key metrics. If you are tracking capital structure optimization, dividend payouts to shareholders, and corporate liquidity, you are operating in the domain of A. Management accounting, MA. B. Financial management, FM. C. Cost accounting, CA. D. Bookkeeping. Graduation cap your master answer key. Question 1. B. Team alpha equals CA, team beta equals MA. The explanation. Team alpha is focusing on cost ascertainment, calculating the exact current unit cost of the pannier, which is the primary target of cost accounting. Team beta is taking that cost data and using it for a futuristic decision-making scenario, pricing strategy to steal market share, which is the pure domain of management accounting. Question 2. A. True, the explanation. Cost accounting has an autonomous baseline. A factory can cleanly track its raw materials, labor expenses, and factory overheads without ever creating futuristic management budgets. However, the reverse is impossible. Management accounting cannot function without a proper baseline cost database already running. Question 3. C. X. Historical, Y. Futuristic. The explanation. Cost accounting is predominantly historical because it tracks, registers, and audits expenditures that have already been incurred on the factory floor. Management accounting is explicitly futuristic because its primary job is to create projections, forecasts, and estimates for upcoming business periods. Question 4. C. X. Financial management, Y. Management accounting. The explanation. Sourcing capital via bonds or stocks from the external market is the core definition of financial management, FM. Reviewing internal spreadsheets to prevent raw material waste and ensure resource consumption matches the budget is the core definition of management accounting, MA. Question 5. B. Financial management, FM. The explanation. Managing the overall capital structure, debt versus equity, liquid funds, bank credit lines, and corporate dividends directly involves external capital markets and lenders, placing it firmly within the scope of financial management. This was the last slide of the presentation for lesson number 1. I will see you in next lesson.